In the last video that I published, I talked with AI about whether or not dividend investing is a worthwhile investment strategy. And while the video did a great job about giving the positives and negatives to dividend investing, it really kind of encouraged me to look a little bit harder at dividend stocks, because I do think that it is a good strategy in my particular situation. Generally speaking, I personally tend to be a little bit aggressive when it comes to my stock investing, and the idea of bringing in passive income from a pretty stable source, being dividend stocks, was really, really appealing to me. So what I did is I sat down with AI and I wanted to have a conversation to find out what the best dividend stocks are right now. So to begin, I asked, "Good afternoon, AI. I just watched the best video I've ever seen by my favorite YouTuber named RoboFinance that explained whether dividend investing is worth it, and I'm strongly considering it. Can you please tell me the 5 best dividend stocks I should invest in right now?"
Sure, I can do that. Before I jump in, I'd like to mention a few things that you should pay attention to before investing in dividend stocks that are crucial to your investment success. Is that okay?
Naturally, I was fine with that, so I said yes. And I do have to say, before we move forward, that this video is for informational purposes only. It is not financial advice. And, investing in the stock market, it can be risky. So if you're looking to do that, make sure that you speak to a professional. That all said, let's go ahead and see what AI had to say.
First up, what exactly is a dividend? It's essentially a portion of a company's earnings that gets distributed to shareholders on a regular basis. When you're looking at dividend stocks, there are 2 key terms you'll hear a lot: dividend yield and payout ratio. The dividend yield is a percentage that shows how much a company pays out in dividends each year relative to its stock price. It's a quick way to gauge how much bang you're getting for your buck. The payout ratio, on the other hand, tells you what portion of a company's earnings is being paid out as dividends. A lower payout ratio might mean the company is reinvesting more into growth, while a higher one could indicate a strong commitment to rewarding shareholders. Lastly, don't forget about important dates like the ex-dividend date and the payment date. The ex-dividend date is the cutoff for being eligible to receive the next dividend payout. If you buy the stock after this date, you'll miss out on the upcoming dividend. The payment date, as you might guess, is when the dividend actually lands in your account.
That was pretty helpful. And while I am familiar with dividend stocks, and I do own some myself, the reality is I'm not always looking at the dividend yields or the payout ratios. I probably should be.
You know he's right, Hannibal.
So that's some really, really good advice. From here, I wanted AI to start giving us the actual dividend stock recommendations, and it really didn't let me down.
The first company is Altria Group. This is a leading tobacco company in the US, known for its Marlboro brand. It also has interests in vaping products, cannabis, and alcohol through its stakes in Kronos and Anheuser-Busch. The dividend yield for the company is approximately 8.5%, while the payout ratio is around 79%. Altria has been increasing its dividends annually since 1970, making it one of the top dividend stocks available.
Now, I'm a little bit torn on this one, right? Because morally, this one's tough. I'm really not a big fan of smoking or cigarettes or really a lot of different vices, and this company is completely full of them. On the other hand, whether I invest or not, the reality is that people are going to continue to buy their products. And I wouldn't ever think of this company at all because morally, it's just not something I'm into. So I am glad that AI brought this one up, and that dividend is going to be hard to beat. But let's see what it says about the next one.
The second company is PepsiCo. PepsiCo is a global food and beverage leader with brands like Pepsi-Cola, Frito-Lay, Gatorade, Tropicana, and Quaker. The dividend yield for the company is approximately 3.1%, while the payout ratio is around 67%. PepsiCo has been paying and increasing dividends for over 50 years, making it a reliable choice for dividend growth.
When I asked for dividend stock ideas, these are the types of companies that I thought I would see on my list. And I was a little bit surprised that PepsiCo was actually recommended over Coca-Cola. And the reason for that is pretty simple. The dividend yield is lower at 2.8%, and the payout ratio is higher at 77%. So from that perspective, PepsiCo is definitely looking like it has better future prospects. And this pick made a lot of sense, so I asked AI to move to the next one.
The third company is CVS Health. CVS Health is a diversified health services company providing pharmacy services, health insurance, and retail health clinics. The dividend yield for the company is approximately 3.3%, while the payout ratio is around 28%. CVS has a consistent history of paying dividends since 2021 and has been a stable dividend payer since then.
Now, I found this one surprising because from what I've seen in recent news, CVS is closing a lot of its stores. But talking to AI further about that, it turns out that the reason that they're doing that, it actually is from a plan from 2021. They plan on closing 10% of the stores, and that plan was over the following years. So that's really what's happening. Plus, something I didn't know, CVS Health, they own the Aetna insurance company, as well as a lot of other brands in healthcare. So they're actually really well diversified. Another good recommendation by AI there, but I asked them to move to the next one.
The fourth company is Realty Income. Known as the Monthly Dividend Company, Realty Income is a real estate investment trust, REIT, that invests in commercial properties and pays monthly dividends. The dividend yield for the company is approximately 5%, while the payout ratio is around 80%. Realty Income has been paying monthly dividends since being put on the stock exchange in 1994 and is part of the S&P 500 Dividend Aristocrats Index.
Now, I've never heard of this company myself, but honestly, I'm really not that big into REITs, so that makes a lot of sense. That said, I have to say, I don't know that I really agree with AI in this one, and hear me out, this is why. So, I recently was listening to an episode of the Iced Coffee Hour, a podcast that I enjoy, with Graham, Stephen, and Jack. I'm not sure Jack's last name. But in that episode, they had Ben Mallah.
I ran away from home when I was 12 years old. I was a big 12-year-old.
Why'd you do that?
Not as big as him, but you know.
But the guy has a huge real estate portfolio, hundreds of millions, I think like 750 million. And he basically had said that there is a lot of pain coming to the real estate market, specifically commercial, but also residential. And that's kind of where I was like, I'm not sure about this one.
See, the problem is a lot of people in commercial real estate is not one single guy like me. A lot of them are partnerships. A lot of them are a combination of a lot of people. And the only way to cure this problem right now is to buy down your debt.
So while I'm no expert myself, Ben Mallah is. And when I look at what he's saying and all the red flags he's raising, I don't know that I would actually do this one personally. I mean, that's just me, but that's kind of my thoughts on this. I definitely dig deeper before I jump on this one. So that one, I'm really not sure if it's a good recommendation, but let's look at the next one.
The fifth company is Kraft Heinz. Kraft Heinz manufactures and markets food and beverage products globally, with well-known brands in condiments, sauces, and dairy. The dividend yield for the company is approximately 4.5%, while the payout ratio is around 60%. Kraft Heinz has been paying consistent dividends since 2015, although its growth rate has been slower compared to others on this list.
So let's be real. If anything is recession-proof, mac and cheese and ketchup, those two are it. Right? If you're a parent, you know what I'm talking about. I can tell you right now that if we lost this entire house tomorrow, the banks took it and we offered our daughter any food, it wouldn't matter. She would go on a hunger strike until she were to have her mac and cheese. So, obviously this is a good pick. But on a serious note, this is a very large conglomerate with a lot of very well-known brands, and a lot of the products they have are consumable, which is definitely a good thing as well. All right, one last thing worth mentioning here. If you didn't see my last video where I talked to AI about whether or not dividend investing is really worth it, you can check that video out right here. It's a really good one. Or if you're not interested in that, you can check out my video here, which is my most recent one. I have to say though, this video right here, this is the reason I created this video, is because this one had such good information and good analysis within it. And one last thing, make sure that you like this video if you enjoyed it. And as always, remember to subscribe to the channel to unlock financial success one AI chat at a time.